speaking about inflation, something that Ian says he was not too familiar with in the early 60s.
No, it didn't exist.
That's the topic we're turning to now, with inflation in South Africa having accelerated by just 0.1%, and this is to 4.7% year on year. And with the MPC meeting tomorrow, we have asked Jana van Deventer, and this is me now butchering her surname. She's an economist at ETM Analytics, and she's here to join us to help us understand the economic outlook. Jana, thank you for making the time to join us. Apologies on the surname, but
Jana van Deventer.
Van Deventer, right.
Okay, you shout at me when I go Nkolosi.
Exactly.
There
we go. Done. So 4.7%, lots of analysts saying, hey, hands up, we didn't see this coming. And it doesn't sound like the Reserve Bank saw it coming either, if we take into consideration their last statements in the last reading.
Yes, the softer than expected CPI number, definitely a welcome surprise. We ourselves were looking for a stronger number, around 5%. If we look at the breakdown of the numbers, it's also encouraging to note that core inflation softened to an over 1 year low. And we believe that the core inflationary pressures that are dissipating is potentially a factor that the SARB can use tomorrow at the MPC meeting as justification for keeping interest rates on hold. Not that we necessarily agree that that's the best way to go at this point in time, but we do think that they might look at that and say there aren't any demand-side price pressures, there is no need for them to hike rates just yet.
Jana, with the oil price having come down, with petrol, the over-recovery is over 30 cents average already and climbing, so we're probably going to get a significant petrol price cut. And with all, from an industrial manufacturing point of view, with all the base commodity prices coming down, doesn't that mean we could look forward to very much lower increases than we had anticipated? And that may just help to anchor interest rates around present levels rather than see too much rise.
Definitely. I think there are quite a number of factors that have changed since the previous MPC meeting. At the previous meeting, the SARB statement was, I believe, sufficiently hawkish to justify a rate increase. But as you've mentioned, Ian, we've had commodity prices coming off again. Also, NERSA didn't grant Eskom that very steep tariff increase. And then also, if you look at how the rand has been performing, it has depreciated on a trade-weighted basis, but perhaps not as much as one might have expected, considering what we've seen over the past 3 weeks with Greece and with China. So, and then finally, I think, and this is quite unfortunately a concerning factor, the macro data that we've had released over the past 2 months have been very discouraging, especially when we look at consumer confidence that collapsed essentially.
The MPC, of course, last time was a 4-3 vote, so it could have gone the other way, and they revealed those numbers now. Janet Yellen said in her recent statement, she said, you've got to be careful not to get behind when you're raising the rates. You mustn't wait too long. Maybe that's in our bank's mind.
Certainly, and that's why we believe that maybe it's not the best move to hold off on hiking interest rates. We do believe the trajectory for the Fed interest rates are skewed higher. Whether they hike this year or early next year, risks are certainly for a hike. And with the SARB having decided to hold off on hiking interest rates, it maybe suggests that at the point when they start hiking interest rates, it might be a little too late and they'll be forced to hike more aggressively further along the line than what might have been needed if they had already started hiking.
Well, it certainly sounds like the story is about staying ahead, and this is what we should be expecting from the SARB tomorrow. Very big thank you to Jana van Deventer. That's take two. She's an economist at ETM Analytics and an independent analyst.